Jewelry isn't a gift you give just once. It's a way to remind your loved one of a beautiful moment every time they see it. Blue Nile can help you find the gift that says how you feel and says it beautifully, with expert guidance and a wide assortment of jewelry of the highest quality at the best price. Go to BlueNile.com and experience the convenience of shopping Blue Nile, the original online jeweler since 1999. That's BlueNile.com to find the perfect jewelry gift for any occasion. BlueNile.com.
Stocks for beginners.
And from my own experience, from the evidence of researching thousands of companies from an ESG perspective, I have come to the conclusion that you cannot really have a company that has strong environmental and social policies without strong governance. Because it points towards the ethical mindset of the leaders of the business.
Hi, and welcome back to Stocks for Beginners. I'm Phil Muscatello. What's volatility, and how do fund managers navigate the dangerous shoals of market downturns? I'm joined today by Craig Mercer from Dalton Investments. Hello, Craig.
Hi, Phil. Thanks for inviting me along.
Thank you. And usually fund managers are wearing much more like a suit than your outfit today.
Yeah, COVID has long since ditched the suit. You know, I spend most of my time working on my own. Comfortable.
I know,
exactly.
It's great these days. So Craig Mercer is the Chief Research Officer and Head of ESG at Dalton Investments Australia. Dalton Investments LLC is a value-based investment management firm with expertise in Asia, emerging markets and global equities. But I just wanted to start off by talking about Johnny Tomahawk.
Sure.
I've got it here.
For obviously those that can't see, he's holding up a book. So that's my pen name and also my gaming handle, if you are into that sort of thing. It's a book I wrote about 10 years ago now. And it was, in some respects, as we were just saying before we came on air, quite similar to what Shares for Beginners is about. I tried to distill in a very short, easy to read format some basic rules for investing. But a lot of, financial texts can be quite boring. And so I try to use pop culture and humor to try and sort of illuminate some of the problems that many sort of novices face when they invest. It's a very short book. It's about 80 so pages long. It's called Bring Me the Horizon. It is still available on Amazon. And effectively, it's meant to be a short read, but to give you some really sort of, maybe humorous stories from my own experience and try and then bring that into the world of sort of the jargon and all of the problems that come with, investing.
Yep, and so as a metal guy, I noticed you had a rebirth into hip-hop in the late 90s, early 2000s.
That's right.
Some advice from the notorious Big, or do you say B.I.G.?
B.I.G., the notorious B.I.G.
The notorious B.I.G.
That's right, So, one of his songs is called The 10 Crack Commandments. But basically, he talks about his own experience dealing drugs before he became a hip-hop star and some of the lessons that he learned. And actually, the 10 Commandments are really quite informative about how to run a business and how to invest and how to trust your client, maybe not using leverage or borrowing money. So there's lots of things like that, throughout the book that are things that, you might not expect to sort of associate with investing, like, the Ninja Turtles, for example, and Astro Boy, which is a very personal story about how much money I lost following a thematic or an idea as opposed to a real business, if you like.
So was that idea, was that in your personal account? Or
PA.
Yep.
PA. I mean, there were a number of fund managers that I worked with around that time that were invested in their own investment portfolios and have subsequently shut down. So, the lesson learned there was like, why not to follow something purely based on, like a dream or an idea. But also the management team of this particular company that made Astro Boy, their original business was making Christmas trees. So what did they know about making movies? And so there's some lessons to be learned there as well about how management teams, I guess, can make really severe mistakes.
Yeah. So I'll date stamp this because we're recording on the 10th of May, 2022, and we're going into a period, and I'm going to make the little quotes, volatility. What's your interpretation of volatility?
Yeah, actually, interestingly enough, thinking back, I hadn't read my book for quite a while because it's been such a long time since I wrote it. But I wrote about volatility quite a lot in the book. And I'm very much of the Benjamin Graham school of thinking that, in the short run, the market is a voting machine. By that, what he means is that at any point in time, the volatility in a market is what people think about the short-term sort of thoughts about where the market direction is going. He went on to say, of course, that in the long run, it's a weighing machine, which ultimately business performance and the quality of a company will shine through over the long run. So we're going through this sort of period of time where markets are volatile purely because people don't really know what's going on in the world. There's all sorts of sort of, exogenous and, endogenous threats, around, and people don't really know what to make of it and heads or tails of it. So ultimately, volatility is not really risk. Warren Buffett has often said things like, if the market was to shut for 10 years, would you be happy owning what you own? And then in 10 years, would you get your money back? So from my perspective, volatility is not risk. Risk is losing your money, or the permanent impairment of capital, as some like to say. So in many respects, we're going through this period of heightened volatility because people's emotions are quite high. The fear and greed sort of premise of the markets is quite extreme at this point in time, but that creates opportunity if you're thinking about the long run. So good businesses with strong business performance over long periods of time should win through this. So there's actually opportunities, if you like. So from our perspective, as a long-term value-oriented firm at Dalton, we're really thinking about where are the great opportunities and where they lie. And does this volatility create opportunity as opposed to sell everything, like everyone else seems to be doing?
So how does this selling operate? I read a lot of Twitter. And
okay.
Everyone's got
It's not a good place to start.
No. There's some good people to follow. But everyone has a different idea about where this volatility comes from. So there's people who need to redeem money, and so they take their money out of funds and ETFs, and then that affects the buying and selling of those particular companies, and it becomes a feedback loop.
Yep.
Would that be how you would characterise the process of what's going on at the moment?
Well, look, there's a number of things. Obviously, we're in an environment where cost of living is clearly rising. Inflationary pressures are genuinely real. When you've got 8% inflation in the US and no wage inflation, or not to the same extent, people's general cost of living are going up. So they need money to fund, their lives. And interest rates, on the other hand, are also going up. So they also need money to maybe fund servicing a mortgage or things like that. So there is some selling in the market because of those kinds of reasons. But a lot of the participants in the market are not investing with a very long-term investment horizon. They're investing in very short-term, I want to make money quick. What's the next hot thing? The Reddit sort of threads that we saw, the hysteria around certain companies. And they're just thinking, oh, the markets are going down, let me just sell. Because they're not really thinking about what they're investing in. They're thinking about the momentum side of investing. And this has been pervasive for probably the past decade. The growth of ETFs has been quite staggering, to be honest, to trillions of dollars from not very much. And I would recommend people actually read that book, Trillions, which is a wonderful examination of how ETFs have grown. It's really insightful. But with that and the ease of accessibility has come a very quick and easy way for people to deploy money that they ordinarily wouldn't have done, without doing much research, I might add. Robin Wigglesworth, I think, is the name of the author, but it's a recently published book. It looks at the whole history of ETFs and how they started from Jack Bogle, Wellington. I didn't realize that Jack Bogle was actually the founder of Wellington, which is an active fund management firm, and was cast out because he wanted to grow the indexation business. And then his actual logo, the Vanguard, the boat is Wellington's boat.
That's right.
And it was like a big, sort of up yours to the Wellington people. He sounds like a really fascinating character. Unfortunately, I never got a chance to meet him.
Yeah, I've actually spoken to a couple of people who've met him. Yeah. And apparently he was very generous. These are people who were employed by Vanguard. And he would eat every day in the staff cafeteria, and people were welcome to come up and talk to him. And one of the guests I had, Jack Bogle, found out that he had a specialty in a particular part of finance that Jack wasn't aware of. And after meeting him in the cafeteria, actually contacted him by email and wanted to learn from this new employee. So that's something that's really important, I think, in investing as well, is just to always keep learning.
Yeah, absolutely. Like, you have to be very open-minded. And this is, again, one of the things that I actually wrote about in Bring Me the Horizon, was that there is a need to constantly learn from people that you probably wouldn't ordinarily think are going to teach you something. One of the big problems that we have in investing is people get sort of really focused into sort of a myopic way of thinking, and they don't challenge their criteria. And this is all behavioral sort of economics, looking for confirmation That confirmation bias is really pervasive in investing. People don't look for the competing argument that might, balance out their own viewpoint. They only seek out the information that reinforces their viewpoint. And so reading books about parts of the market or areas of investing that might not be your wheelhouse or areas that you don't understand should be something that you do as a matter of discipline, as opposed to something that you just, occasionally do. It should be really entrenched into sort of your modus operandi, if that makes sense.
And presumably you've got an investment team that are challenging each other
yes,
every day.
Yeah, absolutely. Very, very different viewpoints. We're an Asian-focused investment firm. So, as you can imagine, we have a lot of different cultures in our business. Myself and the CIO are the only two sort of white guys, if you like, on the team. We have South Americans, we have Indians, we have Japanese, Koreans, Taiwanese, Chinese, Bangladeshis. So we have people from such a wide sort of mishmash of global sort of culture and economies. And as you can imagine, someone, say, from Taiwan and someone from mainland China have a very opposing viewpoint about the role China plays in the global economy. And so that can lead to quite heated discussion and debate, because from the perspective of someone that comes from, Taipei is very different to the perspective of someone that comes from Beijing, because of the news that they consume and the way they're fed information.
Yep.
So that creates, what I call constructive tensions. It informs the debate and it gives us a more open mind, which is what you want. You want a creative tension, if you like.
So what are the conversations like at the moment?
Look, I'd say animated is probably a good way to describe it. There's so many different viewpoints. The biggest areas of discussion that we've been having internally have been around China in particular. With the Russia-Ukraine invasion, there's a lot of thought process. There has been a lot of discussion internally about what will, Xi Jinping do with Taiwan, given what we've seen happening in Hong Kong and now with Hong Kong appointing a new leader that is effectively an extension of Beijing. What does that mean for Taiwan? And what does that mean then in turn for the global semiconductor industry, for example? Taiwan is really integral to the global semiconductor industry. If there was a more, sort of strategic move by the Chinese government into Taiwan, that would be catastrophic for the global economy. There's some of us that probably think that's a higher probability than others, but you can see the way in which the geopolitics around the world are sort of shifting. A lot of Taiwanese companies, by way of example, have started to invest heavily in US-based manufacturing facilities. A lot of companies that were historically doing business in China, with outsourced manufacturing, for example, have started to decouple their supply chains and move back to Japan or back to Taiwan or to other parts of the Asian region, or indeed offshore. India, for example, has been a beneficiary of that. Apple has started to build facilities to manufacture phones in India. Now, that's all as a consequence of, the geopolitical framework. Now, there's probably the very pro-China bulls that will think, it's just a short-term phenomenon. We don't think it's really going to change that much. And then there's the other side of the coin, which is this is something that's going to persist and will continue to sort of decouple. And we're sort of probably more in the latter part of that conversation. And it's also, as head of ESG, one of the things that I think about a lot is with the whole Russia situation, basically immediately cast out as a non-investable market, given what they're doing in Ukraine. And that sort of begs the question, well, how does China fit into that equation? If they're sort of supporting the Russian regime, which they sort of, not necessarily saying they are, but they are through the actions they're taking, and what's going on with the Uyghur community, should an ESG-minded investor be casting the same sort of die on China? And that's a really deep philosophical question in my mind. Russia is not integral to the global economy. Yes, it produces oil, yes, it produces gas, but those are almost replaceable because, they're 8 or 10% of the global sort of supply.
And they're commodities.
They're commodities that can be produced somewhere else. China is, fundamentally integrated into the global economy through manufacturing. I mean, they make everything. So if that's cut off tomorrow, that would have material ramifications for so many different kinds of industries and, sectors that you wouldn't even imagine, you wouldn't even think about, I guess.
And ESG comes into it as well in
terms
of thinking about China as a manufacturing base.
Yeah, of course it does. I mean, one of the things that was really fascinating is in the last few years, the Chinese government has sort of mandated that companies have what they call a CCP committee. So, like in corporate governance terms, say in somewhere like Australia, you have an audit committee and you have a remuneration committee. Well, companies have those things in China, but they also now have a CCP committee.
The Chinese Communist Party.
Exactly, right? So, the conduit between company operation and a conduit to the government, right? So that in itself to Western-minded investment firm or investor
in terms of the governance side of things,
should be a concern, right? Because the Chinese Communist Party is not aligned to your, motives or what you want from a successful sort of investment from a capitalistic standpoint. And they have very different objectives. That's one of the reasons why for many, many years, almost since we started investing in Asia, we've never wanted to invest in state-controlled companies because they're fundamentally misaligned to you as a minority shareholder. The state of China's goals are completely different to what you want
as a shareholder. Yeah. Another thing that's come up recently in terms of the ESG is that, and this is from an article I just read from First Links, and it's about whether armaments manufacturers are now ESG compliant because they're actually doing good in Ukraine.
So you asked, you asked about, what are we talking about? What's the discussion? This has actually been a very, sort of dynamic conversation internally. Is the two things that have come up in conversation is one is, it's all well and good, but should you be allowed as an ESG investor to invest in a weapons manufacturer that's manufacturing weapons for the right people, right? Now, of course, the right people is a highly interpretive statement, but that's almost in some respects a very viable question. The second part of the conversation has been around nuclear energy. Clearly, when Fukushima, the earthquake and the tsunami, destroyed the Fukushima power plant, the global sentiment towards nuclear power completely cratered, and economies and governments all over the world start shutting down nuclear power. Germany, case in point. Now, the debate here is well, the consequence of doing that is that they become ultra reliant on Russian gas and oil for their own power needs.
So there's a geopolitical implication as well as a carbon production implication.
And so the question then becomes, will we start to see nuclear power becoming back on the agenda? And actually, fascinatingly enough, Kishida, the president of Japan, was just in Europe, and he was talking to, a group of investors, and he basically said with quite clear language that they're going to start turning on nuclear power again, because that will circumvent the demand that they need for foreign oil and foreign gas to power their own country. At the same time, there's been some enormous innovations on that side of the fence in terms of how, the big issue with nuclear power clearly is what do you do with waste? And I think in Finland, there's been some really crazy innovations that allow companies to dispose of nuclear waste in a more sustainable sort of fashion, if you like, without causing harm to the environment. Still in the early phases of its sort of, evolution, but nonetheless, these kinds of things that we're seeing in Russia and the Ukraine really start to present these conversations as being, well, actually, are we getting this all wrong? You can't cut off oil and gas from the global economy overnight. There has to be a long-term sustainable transition. But what are the long-term solutions? And I don't think people have quite figured that out yet.
At Staples Business Advantage, our team of experts can help you find the breakroom products to satisfy everyone's preferences, while AI can
suggest popular items, monitor stock levels, optimize pricing, and automate reordering.
AI can do a lot of things.
But I can never know the taste of a truly great cup of coffee. Sigh.
But you also can't get hangry.
This is true.
Let Staples Business Advantage use today's latest innovations, plus our team's experience, to make stocking your team's breakroom easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
So you're mentioning about Chinese companies having a CCP representative
they have to form
level?
a corporate committee that liaises with the government.
Does that occur with Chinese companies that are listed on the NASDAQ?
So that's a very fascinating conversation. So
we know Alibaba, for example.
Yeah, Tencent has done this. But the reality is those companies, and this again has been a hot topic of conversation, is most of those US-listed Chinese companies will have to delist at some point. The US authorities are they're pushing through the legislation, and a lot of it has been pushed through already. They've been either relisting back in, say, Hong Kong, or, bring business back onshore, or they've just gone private. And that whole banning of the ADRs, the American Depository Receipts, really stems from a corporate governance concern, which is all of those listed entities in the US are what they call variable interest entities, which effectively means that they are a Cayman or a British Virgin Islands a domiciled company that has entered into a contractual arrangement with the onshore company in China. And there's almost no transparency between what those contracts actually, intimate. So the auditors can't get clean access to the onshore, accounts in China. They're not able to inspect the companies as they would, say, in the US. And that's really what's led to this was we have no transparency. There was a wonderful example of Alibaba, which did this deal where they spun out Ant Financial being the IPO that was, canned by the Chinese authorities because of control issues. But Ant Financial was spun out of Alibaba at a price that was absolutely ludicrous. And I can't remember the number exactly, but it woefully undervalued the business. But who was the controlling shareholder of Ant Financial? Well, it was Jack Ma. So he was essentially selling the company to himself at a price that was unreasonable. And I'm talking, it was probably sub $10 billion at the time. And then they were going to do an IPO that would have valued the business at $120 billion or whatever it was, which, that screams of bad corporate governance, right?
That's a related party transaction?
That's correct,
yeah,
right?
Yeah.
So Ant Financial was controlled by Alibaba. They were the major shareholder, and it was effectively spun out at a price. And because they control the voting rights of Alibaba, they could do it without other shareholders, approving it. Now, and again, this is one of the major drawbacks of a lot of technology companies, not just Chinese ones. Like WeWork was a great example of this. Facebook, where you have founder controlling shareholders that might own, say, 9% of the equity or 10% of the equity, which is not an immaterial amount of equity. But they structure the equity in such a way that that 10% carries a much more substantive voting, power. So they have Class A shares, which is what the general public owns, and that's 1 share, 1 vote, which is pretty normal practice. But then Class B shares might be 1 share, 10 votes. And the Class B shares is where obviously all the controlling shareholders sit, and they own less than the controlling amount of the total equity of the company, but they control the company. So Alibaba was that kind of example. And almost every single technology company that I can think of in the US has that same kind of structure. So you have a controlling shareholder that's not the controlling owner, if that makes sense.
That's it. Really interesting, because ESG, most people think about ESG and wanting to have a carbon-free future. But the G part of it is governance. And
Absolutely.
This is so important as well. And you're just highlighting so many of these governance issues in many companies.
Absolutely. And it's very hard to think, and from my own experience, from the evidence of researching thousands of companies from an ESG perspective, I have come to the conclusion that you cannot really have a company that has strong environmental and social policies without strong governance, because it points towards the ethical mindset of the leaders of the business. If they structure the governance in such a way that is fundamentally misaligning you as a minority shareholder, how can you really trust what they say they're doing on the E and the S is really correct, right? But you also have no power to enforce the change. So, 1 share, 1 vote should be what everyone does. But the private equity firms around the world have, come to deals to take these companies public from being private, where they've given unfavorable terms, I guess, or favorable to them, to the owners of those businesses when they go public, so that they can retain control, behave like a private enterprise, but spend the public's money, which is, a great transition of wealth, I should say.
In your opinion, is there a company that's getting it right? Let's be optimistic.
There are many companies that are doing this right. I mean, speaking of our area of expertise, I mean, a company like Sony, for example, Sony is a world-class company. It makes products that, almost everyone will have a Sony product probably in their household. But they've really got the E, the S, and to some extent the G correct. Now, the G comes with the caveat that it's Japan. So the mindset of governance in Japan is quite different to maybe what the mindset of good governance might be, say, in the United Kingdom. But in the context of a Japanese corporate, it's got really strong governance sort of credentials. Now, they could probably return more money to shareholders. They could probably be a bit wiser with their capital discipline. But from an ESG standpoint, they've got a lot of it right.
And looking at Asia, Dalton is coming to the view that Asia is becoming one region and should be treated as one region. Can you explain that? Are we talking about South Asia and Southeast Asia? And
it's probably slightly incorrect to say it's becoming one singular market. What we think is you cannot analyze Asia or invest in Asia without looking at the whole region. So that's a subtle difference. And by that, what I mean is you cannot form an opinion on a Japanese technology company or hardware manufacturer, say in the semiconductor industry, if you're not really focusing on what's going on in Taiwan and in Korea, because they are the major competing forces. So if you are a Japanese investor, you really have to be thinking about Asia as a whole. Actually, what we probably think is this decoupling sort of story that I sort of was mentioning is actually Asia is becoming more decentralized. So, you're moving away from China as the dominant sort of trading bloc, if you like, and you're getting more companies spreading out their sort of manufacturing or diversifying it across the region so that they have less disruption, if you like, to supply chains. And that's come as a consequence of probably two major things. The Trump administration, in the first instance, what they did was, they introduced obviously tariffs against China, which forced a lot of companies to think, well, if we're making a product that has got a tariff on it in China, if we move our manufacturing from China to, say, Cambodia or to, Myanmar or to Vietnam, and we don't get that tariff, then let's do that because we can maintain margins. And a lot of companies did that fairly quickly or have been doing that for a long period of time. When COVID started, that accelerated that process because it became even more abundantly clear that the reliance on China for manufacturing was crippling a lot of companies. And we're even seeing it now, with China lockdowns and China's sort of zero COVID approach, being still very prevalent right now. Companies are experiencing supply chain disruptions.
And it's a terrible thing to be so reliant on one country.
That's the thing.
Their one policy.
So a market like Japan, for example, Japan actually introduced tax incentives to a lot of its companies to bring back manufacturing onshore. Now, clearly the issue that is very pervasive in Japan is labor shortages. It's a very old country. They don't have the young, dynamic workforce that really, you need to produce goods, in a factory.
And no immigration either.
Well, so exactly, right? So you have this weird, sort of situation where Japan has the ability to bring some of these things onshore, and there are companies, bizarrely, that specialize in bringing labor into the country, but also automation and, robotics and all those kinds of things where Japan leads the world, allow them to maybe do things with less physical people. And, come back to the point I made earlier, this is one of the reasons why India is going to be a big, in our minds, winner of all of this. They have a very young and dynamic population. And a lot of companies are like, well, India has, a slightly more transparent rule of law, English-based legal system. It's a democracy, the world's largest democracy.
Highly educated workforce.
Highly educated, English-speaking to a large extent. So, there's a lot of things that make it almost a no-brainer. But also, if you're thinking about long-term thematic trends, where is the biggest population in the world in the next 2 decades? It's in India. It's got a huge amount of its population under the age of 30 and quickly becoming, wealthier, which is a large consumption market in itself. And we saw that in China. And so we're going to see sort of, somewhat of a repeat of that whole big economic transformation as more Indians join the workforce, as more Indians earn more money. They not only consume themselves, but at the moment, it's still an economic trade-off for, say, a US manufacturer. You're getting much cheaper labor in India than you are, say, in the US. But as that changes, obviously then there'll be somewhere else where people will ultimately go. And that might well be somewhere in Africa, for example, which is probably the next 50 years.
Dalton engages with portfolio companies, and you encourage them to drive value for shareholders by suggesting opportunistic buybacks of company stock. Tell us about that process. Do you have that much kind of sway with the management of some of these portfolio companies?
The simple answer to that question is both yes and no. So obviously in a small company...
You can ask.
Yeah. Well, you can ask any management company to
Yeah.
do it, right? Whether or not they'll be inclined to listen to you is something entirely different. But in a company, say, with a market capitalization of, say, $200 million US, we can own 10, 15% of those companies. And in that circumstance, you have much more sway because you're oftentimes the second largest shareholder, maybe to the founder that created the company. So yes, you can have some sway, but as I said, like different kinds of management teams have very different responses to any form of sort of active engagement. For the most part, in a market like Japan, where we're probably the most pronounced at this, the knee-jerk reaction is no, we don't want to talk to you. You're a foreigner. Like, what do you know? Now, the most powerful thing that's happened in Japan in the last sort of, say, 10 years is under the Abe government. I think when he came into power in 2012, he introduced a whole range of reforms. Japan has been notorious for poor management of balance sheets, basically, hoarding cash on balance sheet, which comes from, the Asian crisis or the Tokyo bubble popping in 87. This fear that, they always need to be prepared for the worst case environment, which is, as we go through this sort of market correction now, makes these companies arguably a lot more competitive. But because they've done this so aggressively for so long, you have quite literally hundreds of companies that trade at the market value of their share price is less than the cash that they hold in the bank. Now, that is not a great use of, your capital on your balance sheet.
And this comes to the question of capital and how a company should use its capital.
Absolutely.
And buyback is one of the ways that they can deploy
Absolutely.
that capital.
So they could increase dividends, which is another thing that we're very proactive in encouraging, returning capital to shareholders in some form. Buying back shares ultimately means that they return cash to you as an investor. They contract the amount of shares that they have in issuance, which means you get more earnings per share. Because bear in mind, a lot of these companies are actually really good businesses that are generating, sound cash flow. They have growing, operating margins. They have growing businesses. And so the cash just continues to grow because they don't really do anything with it. So they should either buy themselves out and take themselves private because they shouldn't really be necessarily public companies, or they should return that cash to shareholders in some way that is accretive to all shareholders. Now, the bizarre thing that we've come up against in Japan is even though the owner might be the biggest shareholder, they are ultimately the biggest net beneficiary themselves of doing this kind of transaction. But they're reluctant to do it, which to us doesn't make any sense. So being more gentle, a bit sort of engaging with companies over very long periods of time, understanding that we're a long-term shareholder in a business. We're not here just to, strip money out of the business and then walk off. All those kinds of things are really important in a market like Japan. So we've had some successes in doing this. I mean, if we look at our own portfolios, we've had more buybacks and more dividend increases in the last 18 months than we've ever had historically. And a lot of that comes down to the fact that the government is pushing reform, more capital efficiency, enforcing companies to enhance their return on equity, which is forcing management teams to think, we have to do something. Otherwise, we're going to fall foul to the government. They're not necessarily worried about you as the shareholder, but falling foul to the government. And then the Tokyo Stock Exchange itself has introduced a whole sweeping range of regulations that have said basically if you don't meet certain standards, you're going to be delisted from the primary stock market in Tokyo, which, if you know anything about Japanese culture, loss of face is an enormously big thing. And so here you've got a situation where the companies don't want to be demoted from these indices, so have to come up with a plan to, increase the value of their own company to keep themselves in those indices. So whether it's buying back stocks, selling other assets that they might have that are, underperforming, increasing their dividends, buying themselves out, or, doing mergers with others to create a more cohesive end product, if you're end company. Those are all things that are on the table, and they're happening at a reasonably fast pace, which is a really exciting time to be involved in the Japanese market. When prices are already cheap, global stock prices are falling. Japan was cheap before they started falling. They've obviously gone down with the rest of the world. The yen is also at I think a 50-year low relative to the US dollar. So if you're a foreigner buying into Japanese securities, not only are you buying cheap stocks, but you're buying them at a very cheap yen. And then this backdrop of all this governance reform and change makes it a really exciting time to be doing this kind of stuff.
So Craig, tell us about Dalton and how listeners can find out more about you.
Dalton, we're based in the US primarily, but we have offices all over Asia, and like Tokyo in particular. We have a large team. We have people in India, here obviously in Australia, myself, people in Asia, in Hong Kong as well, and Santa Monica, which is where our head office is. DaltonInvestments.com is our website if you want to learn more about what we do. Manage about $3 billion in Asian equities, I guess, primarily in Asian equities and Japanese equities. And that's really what that's our bread and butter. We've been doing it for the best part of 25 years by this stage.
And where can listeners find the book? Are you still available
it's still
on Amazon?
available on Amazon.com or Lulu Publishing, which is the publisher of the book. I think you can buy it directly from the publisher's website. But Amazon.com, it's called Bring Me the Horizon, and the author's name is Johnny Tomahawk. And as I said, if you ever happen to be playing Apex Legends or something and you see that, that's me.
And metal music? Do you play in the metal band as well?
Well, yeah, the book was named after a metal band, Bring Me the Horizon, which is, if you're a fan of that kind of music, quite a big band. One of their songs was the inspiration because it was about breaking away from the crowd, if you like.
Yeah, well, I could always imagine you in a black T-shirt down at Utopia Records.
Actually, I don't go there often enough.
Craig Mercer, thanks very much.
Thank you very much, Phil. Pleasure to meet you, and thanks for your time.
If you found this podcast helpful, please tell a friend, especially if it's someone who needs to start thinking about investing for their future. You'll be helping them and helping me to keep this show on the road.
Stocks for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Stocks for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation.
And thank you for listening to my podcast.
Over 4 decades, Aberdeen has built deep relationships throughout emerging market economies. And each episode of our Emerging Markets Equity podcast is your chance to eavesdrop on an agenda-setting conversation between me, Nick Robinson, and some of our brightest minds, figuring out the opportunities in key emerging markets. Search for the Emerging Markets Equity podcast from Aberdeen, that's ABRDN, wherever you get your podcasts.